banks, shopping baskets, and big tech. A major week is shaping up. Welcome to Market Insight. I'm David Pollard. Retail sales data on Thursday will give markets another reading on the health of the US consumer and a possible insight into an economy that's proving more resilient than many expected. And with earnings season underway, big banks including Goldman Sachs and Bank of America both report on Tuesday. That too could offer a further snapshot of the consumer. Well, John Stoltzfus, Chief Investment Strategist at Oppenheimer Asset Management, is with me. Welcome, John. Let's start with financials. JP Morgan and Wells Fargo have both beaten forecasts with their results today. Does that set the tone for the sector as a whole?
Well, great to be on the show with you, David. Yes, I would say it certainly does set the tone. I think the one caveat would be here that each bank needs to be judged on its own merit, and it will be by the market in terms of results as they cross the plate. Interest margin will be of importance. I think that's one thematic. Also, results from trading, any potential for M&A activity, and most importantly, any guidance from management as they look ahead.
Top billing for the tech sector goes to Netflix earnings next week. Technology, you say in your notes, occupies more or less the same sort of place that the automobile did around 100 years ago. Could there be anything in the sector's upcoming earnings to shake that very upbeat view?
Well, in terms of to shape the upbeat view, I would say we'd want to see a confirmation of what we believe is the ongoing upgrade cycle with both the consumers and business having technologically deeply embedded in their lives on a day-to-day basis. And so when we hear from the tech folks, what we want to hear is we're looking for revenue growth, profitability as always, but in a view looking forward to increased process of adding innovation and capturing the attention of their customers.
Let's move on now to the consumer and the economy. We have retail sales data on Thursday. What do you think that might tell us? What's your picture at the moment of the consumer?
Well, related to my picture of the consumer, this has been one of our favorite sectors along with tech, industrials, and financials all year. And consumer discretionary has lagged up until recently and then had a bit of a fade, a little bit of nervousness in terms of consumer sentiment, both in the conference board as well as in today's University of Michigan consumer sentiment. It seems to go from week to week. It really depends. Does the consumer see mortgage rates falling or does it see mortgage rates rising? Is inflation closer to the Fed's 2% target? Or is the idea that the Fed's 2% target remains elusive? And most importantly, I think with the consumer, it's the pricing of goods. Where can they find the best pricing? The feel still is the consumer is reading concern about inflation at this point. But we think overall, the Fed's success at bringing down the pace of inflation suggests a path forward of greater normalization and much improvement. And we think a rebound in consumer confidence, much like back we had just a little earlier here with everything when they were expecting the Fed was going to cut more rather than less. And I think there's a recognition here that the Fed may take longer to cut, and that's what's upset the consumer a little bit near term.
Well, just to explore that thought a little bit more, markets have been reducing their bets on Fed policy easing after strong labour and other data, but Fed officials over the last week or so have struck a quite dovish tone in their comments. Do you think there's a bit of a disconnect there between the officials and what markets are seeing?
I certainly think so. I think that the Fed has been very clear in our mind on expectations that things are likely to continue to get better, even as they must remain vigilant against inflation and also consider the second part of their mandate, which is to provide an environment which can bring full employment, or what that is interpreted as historically, a level of 3 to 4% unemployment, to just allow for normal changes in employment basis, whether it's job holders moving from job to job or changes within the jobs that are offered. But we'd have to say that from where we stand here, things again are likely getting better rather than worse, with the Fed very much attentive of the fact that it has succeeded thus far with 11 rate hikes and 9 pauses, and now with 1 cut, to have avoided driving the economy into a recession, and that's in bringing the pace of inflation down from nearly 9% down to very close to its 2% target. And recognizing that the actual 2% target still remains somewhat elusive, at least near term.
John Stoltzfus of Oppenheimer Asset Management. It's been great to hear your thoughts today. Many thanks. And that is Market Insight. We have more videos on Reuters.com.